A stock falls 20%. One investor panics and sells. Another sees the same price and starts looking for an opportunity. The price is identical. The company is identical. So why are their reactions completely different? Benjamin Graham's The Intelligent Investor begins with a deceptively simple idea. Successful investing isn't primarily about predicting what the market will do next. It's about learning how to behave when you don't know. Graham wrote the book decades ago, but the problem he was addressing hasn't disappeared. Markets still rise too quickly, investors still chase excitement, and people still make terrible decisions when fear and greed take over. His solution isn't a secret stock-picking formula. It's a way of thinking. At the center of that philosophy is a distinction between investing and speculation. An investor doesn't buy something simply because its price is moving. They ask what they're actually buying. A share represents ownership in a real business. That business has assets, profits, debts, customers, competitors, and future prospects. The stock market simply puts a price on that ownership every day, and that price can be sensible, it can be too high, or it can be surprisingly low. The problem is that investors often reverse the relationship. They see a rising share price and assume the business must be becoming more valuable. But a rising price doesn't prove that. It only tells you what other people are currently willing to pay. This is where Graham introduces one of the most memorable characters in investing, Mr. Market. Imagine that you own part of a business with a strange business partner. Every morning, he arrives at your door and offers to buy your share. But his mood changes constantly. On Monday, he's wildly optimistic and offers you £150. On Tuesday, he's terrified and offers £80. On Wednesday, he's convinced the business is worth £120 again. The business itself hasn't necessarily changed. Mr. Market has. Graham's point is that you don't have to agree with him. His daily quotation is an offer, not an instruction. If the price is attractive, you can take advantage of it. If it's ridiculous, you can ignore it. This sounds obvious, but it's one of the hardest things for investors to do. When prices rise, people feel clever. When prices fall, they feel frightened. And eventually, the investor stops asking, "What is this business worth?" They start asking, "What is everyone else going to do?" That is when investing starts turning into speculation. Graham's answer is to focus on value rather than emotion. But that creates another problem. How do you know what something is actually worth? You don't, at least not with certainty. Any valuation is an estimate. You can study a company's earnings, assets, debts, and future prospects, and still get the answer wrong. This is why Graham's concept of the margin of safety is so important. Suppose you estimate that a business is worth £100 per share. Buying it for £99 leaves very little room for error. Maybe your analysis was slightly optimistic. Maybe profits fall. Maybe the industry changes. Maybe you simply misunderstood the company. But suppose you can buy that same business for £60. Now your estimate doesn't need to be perfect. You have a cushion. That's the margin of safety. It doesn't make an investment risk-free. Nothing does. Instead, it recognizes a basic fact of investing. You will be wrong sometimes. The goal isn't to eliminate mistakes. It's to make sure that one mistake doesn't destroy you. This idea also explains why Graham was so suspicious of popular investments. A company can be excellent, and its stock can still be a terrible purchase. Think about a business that is growing rapidly, has a brilliant brand, and attracts enormous attention. Everyone knows it's successful. That's precisely the problem. If investors become so excited that they push the price far beyond what the business can realistically justify, you're no longer buying a great business at a sensible price. You're buying optimism. And optimism is already included in the price. This is one of the hardest lessons for new investors to accept. A good company isn't automatically a good investment. The price matters, always. Graham also spends considerable time dealing with something investors rarely want to admit: their own emotions. The market doesn't just move prices, it changes how people feel about those prices. When a stock has risen for months, investors become increasingly confident. They see other people making money. They hear stories about someone who doubled their investment. The fear isn't that the stock is expensive. The fear is that they might miss out, so they buy, then the market turns. The same people who were desperate to buy at £150 suddenly can't wait to sell at £90. The business may not have changed enough to justify such a dramatic change in opinion, but emotions have. This is where Graham's philosophy becomes almost counterintuitive. A falling market isn't automatically your enemy. Sometimes lower prices create better opportunities, and a rising market isn't automatically your friend. Sometimes rising prices simply make good investments more expensive. The intelligent investor therefore tries to reverse the instinctive reaction. When everyone is excited, become more cautious. When everyone is terrified, don't automatically run away. That doesn't mean buying every falling stock. A falling company can become an even worse investment. The point is to separate the market's mood from the underlying facts. Graham's Mr. Market gives you a useful mental model for doing exactly that. You don't have to predict his mood. You don't have to argue with him. You simply take advantage of him when his prices become attractive, and when they don't, you wait. That last part is surprisingly important. Investors often feel that they should always be doing something. Buying, selling, rebalancing, searching for the next opportunity. But patience is part of investing. If you can't find an attractive investment, doing nothing is a legitimate decision. The book also distinguishes between two broad approaches: the defensive investor and the enterprising investor. The defensive investor wants simplicity. They don't want to spend hours analyzing individual companies. Their priorities are diversification, quality, sensible prices, and avoiding major mistakes. The enterprising investor is willing to put in much more work. They study companies in greater detail and search for situations where the market price appears significantly lower than the underlying value. But there is a catch. More effort doesn't automatically produce better results. If you don't have the knowledge, time, or discipline to analyze investments properly, trying to behave like a professional can actually increase your risk. This is why Graham's philosophy isn't about making investing complicated. It's about knowing what you're capable of. For many investors, diversification is another important part of that defense. Putting everything into one company creates a dangerous dependence on a single outcome. If you're wrong, the consequences can be enormous. Owning a range of investments doesn't guarantee success, but it reduces the damage caused by one bad decision. And that's really the theme running through the entire book. Don't build a strategy that requires you to be right all the time. Build one that can survive being wrong. That's a very different way of thinking about investing. Instead of asking, how can I make the most money? Graham encourages a more useful question. How can I avoid making a catastrophic mistake? That doesn't sound as exciting, but investing isn't supposed to be exciting. If it feels like a casino, something has probably gone wrong. Graham isn't promising that his approach will make you rich quickly. In fact, the book argues against that mindset. Real investing is slower. It requires patience, discipline, and a willingness to look boring when everyone else is chasing the latest opportunity. You won't always own the most exciting company. You won't always catch the biggest rally. You may even watch other investors make money while you sit on the sidelines. And that's difficult, because the market constantly creates the illusion that everyone else knows something you don't. They usually don't. The headlines are reacting to yesterday, the crowd is reacting to the crowd, and the price is constantly moving because millions of people are making decisions for millions of different reasons. Your advantage isn't knowing what they'll do next. Your advantage is refusing to let their behavior dictate yours. That is why the intelligent investor is ultimately less about stocks than it is about temperament. You need enough discipline to buy when prices are attractive, enough patience to wait when they aren't, enough skepticism to question popular stories, and enough humility to accept that your own analysis can be wrong. The market will always give you another price tomorrow. You don't have to act today. You don't have to predict the next crash. You don't have to find the next stock that doubles. You need a process, and above all, you need control over your own behavior. Because the greatest threat to an investor isn't always a collapsing market. Sometimes it's the decision made when the market is making you afraid. Benjamin Graham's central lesson is therefore remarkably simple. The intelligent investor isn't the person who knows what the market will do next. It's the person who doesn't need to know.